So it's January 23, 2009, and you were sitting in this office, right, looking out over the River Thames.
Right.
And you're basically watching the entire global banking system just quite literally melt down.
Oh, yeah. Total chaos.
Just a sea of red on the screens. Like financial institutions that have literally stood for centuries are teetering on the edge of oblivion.
Exactly.
And you're the author of the system we are exploring today, and you're about to make a trade for your own personal portfolio. And you've planned this out meticulously. You've done all this grueling intellectual heavy lifting.
Yeah, he had it all mapped out.
Right. Because you predicted that the absolute best time to buy banking stocks is when the darkest, most terrifying economic fears are just finally confirmed by the official numbers.
Yeah.
So you've chosen Barclays. You know their balance sheet inside and out. The plan is locked in.
Yeah.
You're going to risk 10% of your portfolio on this single trade.
Which is, I mean, on paper, it's a brilliant setup. It's this completely rational, deeply researched plan based on, extensive market history and a really contrarian understanding of market psychology. The intellectual battle at this point has already been won.
Right. The hard part is supposed to be over.
Yeah.
So the moment arrives, the UK GDP numbers hit the wire, and they are just abysmal, like worse than anyone even feared.
Yeah, I think it was, 1.5% down in a single quarter?
Exactly. The UK GDP falls by 1.5%. And Barclays stock just immediately plummets 15% down to 53 pence, which is a level that was previously completely unthinkable.
Right.
So the plan is playing out flawlessly. The trap is sprung. All you have to do is hit the button and execute the trade exactly as you planned.
Right.
But suddenly, and this is the wild part, your heart rate spikes.
Oh, the adrenaline just completely
Yeah.
takes it.
Yeah. Fear, this primal, overwhelming fear just floods your brain. And you start second-guessing yourself. You start thinking, well, what if this isn't just a dip? What if the entire global financial system is actually literally evaporating into dust?
Which was a real feeling back then.
Oh, absolutely. So panic sets in. You frantically alter your orders. You literally knock a zero off your trade. Instead of risking 10% of your net worth, you risk 1%.
And you end up buying in at 53 pence?
Yes, you buy in, just at a much smaller size.
Yeah.
And then, just a few months later, the fear subsides, the market stabilizes, and you sell those exact same shares at an average of £2.50.
Which, I mean, purely in terms of percentage, is a phenomenal, almost unbelievable return on investment. It's basically a 500% gain.
It's a legendary trade.
Yeah.
But because of that last-second emotional panic, right, because you just couldn't stomach the sheer terror of the moment and knock that zero off your position size, it literally cost you a life-changing fortune.
It really did.
You did all the intellectual work, but you failed the execution because, well, you are a human being, and human beings get scared.
We do. We panic.
So I want to contrast that human failure with a second story from the very same author. Let's rewind the clock just a few months earlier to September 2008. The financial world isn't just melting down. It feels like it's literally ending. Lehman Brothers has collapsed. ARG's being bailed out. Freddie Mac, Fannie Mae going.
The volatility during those weeks was, it was something most seasoned veterans had never witnessed before and, frankly, hope to never witness again.
Right.
The sheer velocity of those price collapses completely broke historical models.
Totally. And in the author's hedge fund office, the human traders, these are, the smartest, most highly compensated guys in the room. They are absolutely terrified.
Yeah, they're losing their minds.
They're having these crisis meetings in glass boardrooms, seriously debating whether they should just liquidate absolutely everything, like pull all their firm's cash out of the banking system entirely, buy physical gold bars, and basically just head for the hills.
It sounds crazy now, but that was the mood.
But down the hall, while the humans are hyperventilating, the firm's computer system is just quietly churning away. The servers, they don't watch the news. They don't care about Lehman Brothers,
No, they have no idea.
The system is simply following its pre-programmed mathematical rules, mechanically exploiting these massive, savage market trends. And while the humans are literally debating pulling the plug on the whole operation, a colleague points to a monitor showing the live daily profit and loss. And for the first time in the firm's history, the computers have generated a 10-digit number.
A billion.
The system made over $1 billion in a single day.
It's just wild. And that juxtaposition right there, that is the crux of everything we are exploring today. You have human intelligence, right, which is vastly superior for complex, nuanced, analytical tasks.
Yeah.
Like the author's discretionary analysis of that Barclays trade was something a simple trend-following rule could never actually replicate.
Right, the computer wouldn't have known to look for that specific GDP trigger.
Exactly. But our evolutionary emotional baggage completely paralyzes us from executing our own brilliant plans under the pressure of real-world risks.
Yeah.
The automated systems, on the other hand, they capture that human intelligence in the form of rules, but crucially, they strip out the emotion right at the point of execution.
Welcome to today's deep dive. Our mission for you today is to provide a comprehensive, rigorous shortcut to understanding exactly why your own brain is practically engineered to sabotage your wealth. And, more importantly, how you can build a modular objective framework to protect your investments from yourself.
It's so important.
We are drawing heavily today from Robert Carver's masterclass on the mechanics of systematic trading. He's a guy who has managed massive systematic portfolios and his own personal wealth, and he's laid out the exact architecture of how this is actually done.
Yeah, his stuff is incredibly thorough.
Okay, let's unpack this. Because the contrast between the panicking human and the billion-dollar computer, it immediately reminds me of Odysseus.
Oh, the Greek myth.
Yeah. He knows his ship has to sail past the sirens, and he knows their song is so beautiful it will literally drive him insane and force him to steer his ship into the rocks. He's intellectually aware of his future irrationality.
Right, he knows he's going to lose his mind.
Exactly. So what does he do? He has his crew plug their ears with wax, and he has them tie him to the mast of the ship with thick ropes. He relies on a mechanical system to physically restrain him from acting on his own inevitable emotions.
It is honestly the perfect analogy for systematic investing. The rules are the ropes, and the framework itself is the mast.
But here's where I kind of get stuck with this. If we are the ones acting as our own crew, right? If we are the ones tying our own knots, how do we make sure we don't just, untie ourselves the second the stock market starts crashing and those sirens start singing?
That is the ultimate dilemma of personal finance right there. To tie knots that actually hold, you first have to understand the very specific shape of the monster you are trying to restrain. You can't just say, oh, well, I get scared sometimes. You have to map the exact cognitive and statistical flaws that actually cause that fear. If we're going to engineer our way out of our own psychology, we have to start by dissecting the flawed human brain itself.
Because for decades, academia didn't even think there was a monster to restrain, did they?
Not at all.
Like classical finance textbooks were built entirely on this mythological creature called rational economic man. The assumption was that you, me, and literally every trader on Wall Street always made perfectly logical, emotionless decisions to maximize our long-term wealth, and therefore markets were just perfectly efficient all the time.
Which is an assumption that evolutionary biologists and psychologists have always found utterly laughable.
I mean, yeah.
We are not Excel spreadsheets, We are basically just primates in suits. And in the 1980s, behavioral finance pioneers like Daniel Kahneman and Amos Tversky, they completely disrupted that classical model. They introduced a framework known as prospect theory, which essentially proves that we carry this deep, maladaptive evolutionary baggage. Our brains are hardwired for immediate survival on a savanna, right? Not for compounding wealth over decades in a digital stock market.
So what does prospect theory actually look like in practice? Like when I open my brokerage app on my phone, how is my evolutionary baggage messing with my trades?
It manifests as these completely irrational asymmetric risk preferences. So prospect theory demonstrates that the pain we feel from losing $100 is roughly twice as intense as the joy we feel from making $100.
Without double the intensity.
Double. And because of this, when we are losing money, we actually take more risk. We become desperate to get back to zero. This is a cognitive bias known as Get-Evenitis.
Get-Evenitis. I love that term.
It's so accurate, though. You buy a stock, it drops 20%, and instead of just admitting you made a mistake in selling, you hold on.
Yeah, you freeze.
You might even buy more. You refuse to view a paper loss on a screen as a real loss until you actually hit the sell button, because selling crystallizes the failure.
Right, because if you don't sell, it's not a loss yet. You are basically holding on to hope, not an investment.
Exactly. It's all about hope. But it gets worse because prospect theory also shows that when we are winning, we do the exact opposite.
Wait, how so?
We become hyper-conservative. We want to lock in that certain gain immediately because we suffer from immense regret aversion. So if a stock you own goes up 10%, you are suddenly terrified that it will fall back to where you bought it, and that would make you look foolish.
Oh.
So you just snatch that small profit right away. The net catastrophic result of these two deeply ingrained instincts is that human beings are fundamentally hardwired to run their losses indefinitely and cut their profits incredibly short.
Which is literally the mathematical inversion of how you actually make money in markets. You are supposed to cut losses and let profits run.
Exactly backwards.
Yeah. And the author highlights his own battle with this exact thing, using some trades he made on BP, British Petroleum. So back in 2004, he bought BP shares. Almost immediately, they went up by about 5%. And just like you said, that regret aversion kicked in hard. He felt this overwhelming urge to lock in the game, so he sold. And he felt like a total genius, for about a week.
Naturally.
But then the shares just kept rallying. They went much, much higher over the next few years. And he was furious with himself for leaving all that money on the table. He mentally scarred himself and swore he would never, ever sell a winning position too quickly again.
And that right there, he took the absolute wrong lesson from the experience. He let a cognitive bias mutate into a rigid emotional rule.
Yes, and that mutation set him up for a total disaster. Fast forward to late 2009, he decides to buy back into BP. The shares go from £5 to over £6. He is feeling completely vindicated. Like, see, I held on this time.
Right.
But then, in April 2010, the Deepwater Horizon drilling rig explodes in the Gulf of Mexico. It is an unmitigated environmental and financial catastrophe for the company. Like, the core fundamentals of the business change overnight.
Oh, he's devastated.
Within a month, the shares collapse back down to £5. Now, a rational actor would look at the literal oil spilling into the ocean and the looming multi-billion-dollar lawsuits and sell immediately. But our author is paralyzed by the ghost of 2004.
Get-Evenitis takes over.
Completely. Yeah. He refuses to sell. He stubbornly holds on, riding the stock all the way down as the news just gets worse and worse. The financial pain becomes absolutely excruciating until he finally capitulates and hits sell at £3 a share. And naturally, because markets love to punish maximum pain, £3 turned out to be the absolute bottom of the market before it rebounded.
It is a phenomenal case study because he got it spectacularly wrong in both directions, driven entirely by his internal emotional narratives rather than the external reality of the market. And we cannot just write this off as, one guy having a bad streak. This is highly predictable, systematic human error. In fact, to prove just how universally destructive our instincts are, the author details a fascinating backtest. He actually programmed two very simple automated mirror image trading rules to see how they would perform over history.
Oh, right. Tell me about these mirror rules, because I think this is where the rubber really meets the road on proving how bad our brains are at this.
So the first rule he programmed was called the early profit taker. This rule mathematically mimics the flawed human instincts we just talked about.
Okay.
It takes profit on very small price rises, locking in those tiny gains immediately, and it lets losses grow quite large before it finally triggers a stop loss. It behaves exactly like a nervous retail trader.
Okay, so that's the human default setting.
Exactly. Then the second rule was the early loss taker. This rule forces the system to do the exact opposite of human comfort. It ruthlessly cuts losses at the very first sign of trouble, and it absolutely refuses to take profits early, letting winning trades run as far as they can possibly go.
The anti-human rule.
Right. So he then unleashed these two rules on historical data for 31 different futures contracts. We're talking everything from stock indices to agricultural commodities to government bonds spanning decades of data. The results were completely unambiguous. The early loss taker, the rule that actively fights our natural psychology, was profitable in 27 out of the 31 markets.
Oh, wow.
And the early profit taker, the rule that mimics our human intuition, systematically destroyed wealth across the board.
That is just staggering. I mean, we were literally walking into the casino with a brain wired to bankrupt us.
We really are.
And speaking of casinos, it gets even darker, right? When you look at the actual mechanics of frequent discretionary day trading, it shares the exact same 3 psychological ingredients found in the most viciously addictive forms of gambling, like slot machines.
Oh, absolutely.
We are talking about the illusion of control, the phenomenon of near misses, and rapid, continuous play.
Yeah, if you literally dissect a slot machine, It is engineered to exploit those three specific things. Discretionary day trading just does the same thing organically. The illusion of control is massive. Like, you read a few earnings reports, you draw some colorful lines on a chart, and you genuinely believe your analysis gives you a proprietary edge over a multi-trillion-dollar global market.
It's kind of arrogant when you put it like that.
It is. And then, when a trade goes against you but then almost recovers before crashing again, that's a near miss. It floods your brain with dopamine, convincing you that you were almost right and you just need to try one more time. And the rapid, continuous play of modern zero-commission trading apps, that ensures that dopamine loop just never closes. You are being stimulated constantly.
And what fuels all of this? Like, what is the root cause that makes us think we can beat the game in the first place?
It all stems from our ultimate, most pervasive cognitive bias, which is simply overconfidence.
Yeah.
We simply believe we are better, smarter, and luckier than average. The author categorizes the destructive results of this overconfidence into what he calls the 3 oversins.
Walk us through those sins. I feel like this is a confessional.
It kind of is. So the first sin is overfitting. This is a direct byproduct of the narrative fallacy. See, the human brain is the greatest pattern-matching machine in the known universe. It is so good at finding patterns that it routinely finds them in pure random noise.
Right, like seeing shapes in the clouds.
Exactly. If you look at a cloud long enough, you see a face. If you look at market data long enough, you see a guaranteed winning strategy. We tune our discretionary rules to perfectly fit past events, creating this compelling, logical story about why a stock moved. But those perfectly fitted rules fail instantly in the chaos of the real, unpredictable future.
Okay, that makes sense. What's sin number 2?
Overtrading. This is illusory superiority in action. We trade constantly, darting in and out of positions, completely blind to the fact that the friction of trading costs, the bid-ask spread, the slippage, the broker fees, is silently bleeding our accounts dry.
Death by 1,000 cuts.
Exactly. We honestly think our stock picking is so incredibly good that it can somehow overcome that mathematical drag.
So if overtrading is death by 1,000 cuts from fees, there has to be a more, catastrophic way people blow up their accounts. Are they just borrowing too much money?
Yes. And that brings us to the third and definitely most lethal sin, overbetting. This is unbounded confidence leading to ruinous leverage. People use margin accounts, options, and spread bets to lever up their positions, completely ignoring the immutable mathematical realities of risk and volatility.
Okay, let's pause on overbetting for a second because the author gets deeply mathematical here, and I want to make sure we, and by we, I really mean me and the listener, actually grasp this, because it feels like the silent killer of portfolios. He says that while average returns scale linearly over time, risk or standard deviation scales with the square root of time. I'm going to need you to unpack that. How does that math actually work?
It is a fundamental statistical concept that almost no amateur traders understand, but it's crucial. Let's walk through it slowly. Imagine a standard trading year has roughly 256 business days where the markets are actually open.
Okay, 256 days, got it.
The square root of 256 is exactly 16. This is the magic number. It means that to convert your daily risk, which is your portfolio's daily standard deviation, into an annualized yearly figure, you don't multiply by 256.
Right.
You multiply by 16. So the risk grows much, much slower than the time does. But the terrifying part is when people try to calculate backwards from their grand ambitions.
Okay, so let me put myself in the shoes of an aggressive day trader on Reddit. I have a margin account, and I decide I want to go for broke. I leverage my account to aim for a 200% annualized volatility bet. I want wild swings because I want massive returns. What am I actually facing mathematically? Like, what's my day-to-day reality?
Mathematically, taking a 200% annualized volatility bet is practically a guarantee of catastrophic ruin. Let's do the reverse math. If your targeted annualized volatility is 200%, you divide that by our magic number, 16, to find out what your daily volatility is.
Okay.
200 divided by 16 is 12.5%. That means on an average Tuesday, your portfolio is swinging up or down by 12.5%.
I mean, that sounds super stressful, but not instantly fatal, right? Like, I could survive a 12% drop.
It isn't fatal until you hit a tail event.
No.
See, in a normal statistical distribution, a 3 sigma event, which is a market move that is 3 times larger than your standard deviation, happens roughly once every 3 years.
Oh, I see where this is going.
Yeah. So 3 times your daily volatility of 12.5% is 37.5%. That means, purely according to the math, if you take that level of leverage, you will face a single-day loss of nearly 40% of your entire net worth about once every 3 years.
Wait, Once every 3 years, I lose 40% in a single day.
Yes. And honestly, that is the optimistic scenario.
How is that optimistic?
Because that math assumes financial returns follow a perfectly normal bell curve. But they don't. Markets are notoriously fat-tailed. Extreme crashes happen far more frequently in the real world than a neat little bell curve predicts. If you run a 200% volatility target, you aren't investing. You are literally playing Russian roulette with a fully loaded cylinder.
Okay, wow. So if our internal monologue is this toxic, and our instincts are perfectly inverted, and if our overconfidence blinds us to the basic math of ruin, is the only solution to just give up? Do we just hand our wallets over to an AI robot and walk away?
Well, not necessarily. Full automation is a fantastic commitment mechanism, but it isn't the software code itself that saves you. The actual mechanism that protects your wealth is objectivity. A system must be completely transparent, and it must be strictly rule-based. It creates a clear, undeniable line in the sand.
So can't bargain with it.
Precisely. If your rule says sell when the price drops 10% and the price drops 10%, you have to sell. If you don't, you can't lie to yourself and say, oh, the fundamentals are still strong. You have to look in the mirror and admit you are blatantly cheating on your own system. Only objective mathematical rules can be rigorously backtested, and only objective systems can prevent you from moving the goalposts when those sirens start singing.
Okay, but if objectivity is the cure, what exactly are we being objective about? Because I could make an objective rule that says I buy Apple stock every time it rains in London.
Sure.
That's totally objective, but it's also incredibly stupid. Where do we find rules that actually make money? If markets are mostly efficient, why would any rule generate a profit against millions of other super smart people?
That's the million-dollar question. To find trading rules that actually have a real edge, quantitative researchers generally choose between two distinct philosophical paths: data first or ideas first.
Okay.
The data first approach is essentially massive-scale data mining. You throw immense cloud computing power and machine learning algorithms at decades of historical tick data. You basically tell the computer to find any hidden, complex mathematical pattern that correlates with future price movements, and then you build a rule to exploit it. The entire mindset is, I don't need to know why this pattern works, I just trust the algorithm that says it does.
Let me push back on that for a second. Isn't that exactly what the most advanced AI hedge funds do? Isn't artificial intelligence basically just massive data mining? Why is that a bad approach for us?
Because of the narrative fallacy we mentioned earlier, and the sheer amount of noise in financial data. Look, physics data is clean. A dropped apple always falls. Financial data is incredibly messy and driven by fickle human sentiment. If you mine data long enough, an algorithm will absolutely find a period in history where the S&P 500 perfectly tracked the price of butter in Wisconsin.
Right.
The data-first approach practically guarantees overfitting. You find a fluke that worked in the past but will never ever repeat in the future. That is exactly why the author strongly, almost dogmatically, advocates for the ideas-first approach.
So how does ideas first protect us from the butter in Wisconsin?
In ideas first, you never start with the data. You start with a hypothesis about human behavior or macroeconomics or market structure. You have to articulate a logical, real-world reason why a specific market inefficiency should exist. You translate that idea into the simplest possible mathematical rule, and only then do you test it against the historical data to see if you are actually right. If the backtest fails, you throw the idea away. But if it succeeds, you end up with a simple, intuitive rule where you know exactly why you are making money.
So what are these ideas? Because profits aren't magic, right? If I am making $1, someone else is losing $1, or at least giving up some potential upside. Where is a profit actually sourced from?
The author outlines 5 distinct, logical sources of profit that systematic rules can harvest. The first, and definitely most common, is risk premia. This is simply getting paid to hold risk that someone else wants to offload.
Like what?
For example, over a 50-year timeline, you expect to earn more money holding volatile equities than you do holding ultra-safe government bonds. You are essentially acting as an insurance provider against inflation and economic stagnation, and you collect a premium for bearing that day-to-day volatility.
That makes total sense. What is the second source?
Leverage aversion. This is a really fascinating structural inefficiency. Many massive market participants, like pension funds, endowments, or even just cautious retail investors, are legally or psychologically prevented from borrowing money to invest.
Wait, can you explain how that creates an opportunity for me?
Sure. Imagine a pension fund that needs to hit a 7% annual return to pay its retirees. They can't just buy ultra-safe bonds yielding 3% because they'd completely miss their target. Now, if they were allowed to use leverage, they could borrow money, buy tons of 3% bonds, and artificially boost their return to 7% while taking very little underlying price risk.
Right.
But because they are averse to leverage or legally barred from using it, they're forced to overpay for inherently risky, high-return assets like tech stocks or private equity just to hit that 7%.
Oh, I see.
This massive structural demand leaves the safer, lower volatility assets underpriced relative to their true risk. So a systematic trader who can use leverage safely can step in, buy those underpriced safe assets, apply a little leverage, and harvest that inefficiency.
Wow. Okay, so risk premia, leverage aversion. What about liquidity premia?
That one's pretty straightforward. It's simply getting paid extra for locking your capital up in assets that are difficult to sell quickly, like real estate or obscure corporate bonds. You demand a higher return for the inconvenience of not having instant access to your cash.
Okay, got it. The fourth one is forced traders. Now, this one is incredible. Who is a forced trader? Give me a concrete example of that.
A forced trader is an entity that must buy or sell an asset regardless of the current market price, usually due to a mandate or some kind of crisis. The most spectacular example in modern history is the Swiss National Bank, the SNB.
What do they do?
Well, during the European debt crisis, investors were terrified of the euro, so they frantically bought Swiss francs as a safe haven. This massive buying drove the value of the franc incredibly high, which was actively destroying Switzerland's export economy because their goods just became way too expensive globally.
So what did the SMB do to stop it?
In 2011, they stepped in as a massive forced trader. They announced a rigid floor. They literally declared they would print infinite amounts of Swiss francs and sell them to buy euros just to ensure the exchange rate never dropped below 1.2 or more francs per euro.
Wow.
And for years, systematic carry traders made an absolute fortune piggybacking on this. They knew the SMB was a forced buyer, providing an artificial floor, so they could harvest the interest rate difference with practically zero perceived risk.
But forced trades don't last forever.
Yeah, exactly. And when they break, the violence is historic. On January 15th, 2015, the SNB unexpectedly abandoned the peg. They just stopped being a forced trader. In a matter of minutes, the euro collapsed by roughly 30% against the francs. Hedge funds blew up. Retail brokerages went bankrupt instantly because their clients' accounts went massively negative.
In minutes.
In minutes. It proves that forced traders provide a really rich source of profit, but the moment they step away, the market violently snaps back to reality.
Which brings us to the fifth and final source, behavioral effects. And this is where we harvest everything we talked about in the beginning. When discretionary traders are suffering from prospect theory, when they are stubbornly holding on to their losing stocks and desperately selling their winners too early, a completely emotionless, automated trend-following rule is basically sitting on the other side of those trades, patiently collecting the money those panicking humans are leaving on the table. So we know where the money comes from. But here's where it gets really interesting. If I build a system that perfectly harvests all these sources, what does a realistic return actually look like? Because, I mean, my Twitter feed is full of guys in rented Lamborghinis telling me I should be doubling my account every single month.
Yeah, and this is where we have to deliver some very cold, very sobering mathematical truths. The universal standard for measuring risk-adjusted returns in professional finance is called the Sharpe ratio.
The Sharpe ratio.
Right. It calculates the excess return you generate above a safe cash rate, and it divides that by the standard deviation, the volatility of those returns. Essentially, it tells you how smooth the ride is.
So what is a realistic Sharpe ratio?
If you buy and hold a single long-only equity index like the S&P 500, a realistic long-term annualized Sharpe ratio is around 0.3 or maybe 0.4. If you build a highly sophisticated, globally diversified, static portfolio spanning global equities, sovereign bonds, and commodities, you might push that Sharpe up to about 0.5 or 0.6, but listen to this. Even for a staunch, elite, systematic trader using dynamic, complex rules, sustaining a Sharpe ratio above 1.0 over a decade is incredibly rare and worthy of industry awards.
Wait, a Sharpe of 0.5? That's it?
That's it.
So when I see an online trading guru selling a course,
Okay.
they post a back-tested equity curve that just goes straight up at a 45-degree angle, claiming a Sharpe ratio of 2.0 or 3.0, are they just outright lying, or is there some trick they're using to manipulate the math?
Usually they aren't forging the numbers outright, but they are almost certainly falling into one of two incredibly dangerous statistical traps that artificially inflate back-tested Sharpe ratios. And both of these lead to utter ruin when traded with real money. The first trap is ignoring the friction of trading faster.
How does trading faster fake a high Sharpe P?
There is this concept called the fundamental law of active management. It mathematically suggests that the more independent bets you make, the higher your Sharpe ratio will be, assuming you have even a tiny edge. So if running a trend strategy on monthly data gives you a 0.40 Sharpe, a naive quant will look at that and say, great, I'll just run the same strategy on hourly data. I'll make 1,000 times more bets, and my Sharpe will mathematically skyrocket to 5.0.
I mean, that sounds perfectly logical in a spreadsheet. Why doesn't it work?
Because the spreadsheet usually ignores or completely underestimates trading costs. Every single time you trade, you pay a toll. You cross the bid-ask spread, you pay a commission, and your order causes slippage in the market price. The also provides a devastating real-world teardown of a very popular retail spread betting system being promoted online.
Oh, look at it.
The system's rules advise the user to put 5 to 10% of their total capital into each trade, and on average, to hold the trade for just a few days.
That sounds like a lot of turnover.
It is massive turnover. When the author actually calculated the true costs of crossing the spread on a retail index bet for that specific frequency, he found that just to break even, literally just to not lose money to the broker, the system would need to generate a raw return of 83% a year.
83% just to break even.
Yes. And because risking 10% per trade carries massive volatility, to avoid a high probability of totally bankrupting the account, the pre-cost return would actually need to be 339% a year.
That's insane.
It is a mathematical fantasy. The friction just eats you alive.
Okay, so trap number 1 is the illusion of speed masking the reality of fees. What is the second trap for these magical high Sharpe systems?
The second trap is the most sinister because it is deeply hidden in the math itself. It is negative skew. If you understand nothing else about market statistics today, you must understand skew.
Okay, I want to make sure I really get this. I've heard the term before. Give me a deep dive into skew. What exactly is it and how does it hide?
Skew measures the asymmetry of your returns. Let's start with positive skew. Positive skew is like buying a fire insurance policy on your house. Every single month, you experience a small, guaranteed loss. You pay the premium, your win rate is terrible, you lose money 99% of the time.
Right.
But on the rare occasion that your house actually burns down, you experience a massive, sudden...
I mean, that sounds amazing. Why is that a trap? Wait, so negative skew is like picking up pennies in front of a steamroller. Your daily win rate is incredible. You are making money every single day, right up until the moment you stumble, the market crashes, and you get absolutely flattened, losing everything.
That is the perfect analogy, and here's why it fools people. The Sharpe ratio calculation is completely blind to skew.
Wait, really?
Yes. The Sharpe formula assumes your returns are distributed in a neat, symmetrical bell curve. It cannot differentiate between a strategy that slowly grinds out profits safely and one that hides a ticking time bomb. So a negative skew strategy will show a phenomenally high Sharpe ratio in a backtest right up until the very day it blows up.
Give me a historical example of this. When has negative skew blown someone up in the real world?
The most famous example is Nick Leeson. He's the rogue trader who single-handedly brought down Barings Bank, which was a 233-year-old British financial institution, in 1995.
Oh, yeah.
Leeson was stationed in Singapore, and on paper, he was an absolute genius. He was generating massive, incredibly consistent profits for the bank. But he wasn't finding actual alpha. He was just selling volatility. He was trading strategies like short straddles on the Nikkei 225 index.
Which means he was essentially selling earthquake insurance to the Japanese stock market.
Exactly. And as long as the Japanese market stayed relatively calm and didn't move too much in either direction, Leeson collected the premiums. His daily returns looked incredibly smooth. Classic negative skew. But when minor losses started to accumulate, instead of taking the loss, he doubled down, hiding his losing trades in a secret, unaudited account numbered 88888.
Oh, man. Get-Evenitis on a corporate scale.
Precisely. He kept doubling down, picking up more and more pennies, getting closer and closer to the steamroller, and then the steamroller hit.
Huh.
In January 1995, the massive Kobe earthquake struck Japan. The Nikkei index plummeted. The volatility absolutely exploded. The insurance policies Leeson had sold suddenly all required massive payouts. And because he had doubled down so heavily, the negative skew tail risk materialized all at once. Within days, he racked up over $1 billion in losses, bankrupting the entire bank.
That is terrifying.
So if you ever see an internet guru showing a backtest with an incredibly smooth upward curve and a Sharpe ratio of 2.0, You are almost certainly looking at someone selling insurance, hiding massive negative skew, and just hoping the earthquake doesn't happen while they collect your subscription fee.
Okay, so if Sharpe ratios can be gamed by ignoring fees or hiding negative skew, how do we ever actually know if a rule is good? This brings us to the danger of the data itself. Because if giving a human historical data is like giving matches to an arsonist, how do we backtest without fooling ourselves?
To understand the danger here, let me share an anecdote from the book that still makes professional quants cringe. The author was visiting a proprietary trading firm to potentially consult for them. The boss of the firm proudly introduces him to their new star employee, right? This junior quant kid straight out of university who has only been there a month. The kid boasts that using his advanced software, he has already data mined 50 brand new, highly complex trading rules that are all wildly profitable in backtests. The computer just spat them out.
Wait, why is that bad? If he found 50 profitable models in a month, shouldn't they give him a huge bonus?
The author politely smiled and nodded, knowing full well that this firm was completely doomed. And sure enough, the firm liquidated a few months later. That kid was dangerous because he was committing the cardinal sin of quantitative finance in sample testing. He was basically cheating with a time machine.
Hold on, give me an analogy here, because I want to make sure the listener is vividly visualizing this trap. Is in-sample testing like taking a time machine to tomorrow, reading the sports section of the newspaper to see exactly which horse wins the 3 p.m. race, going back to today, writing a complex algorithm that predicts that specific horse will win, and then showing off your algorithm's 100% success rate on historical data?
That is exactly what it is. Let's apply it to market data. Imagine you have a decade of historical daily prices for the S&P 500, from 1990 to the end of 1999. In-sample testing means you use that entire decade of data to test thousands of variations of a rule, say every moving average length from 2 days to 200 days.
Yeah.
You find that a 42-day moving average happened to perfectly catch every dip and ride every rally during that specific 10-year period. You then run your final backtest over that exact same 1990 to 1999 period, print out a chart showing massive profits, and declare, look how beautifully my 42-day rule performs.
But you didn't know 42 days was the magic number in 1990. You used data from the dot-com bubble in 1999 to retroactively optimize a trade you supposedly made during the Gulf War in 1991. You peeked into the future.
It is profoundly dishonest, and it leads to wildly optimistic expectations that will instantly collapse when applied to live markets, where you don't actually have tomorrow's newspaper. The only rigorous solution is out-of-sample testing. You must create an impenetrable firewall between the data you use to design and calibrate the model and the data you use to evaluate its performance.
I understand the theory of that. How does that actually work in practice without running out of data entirely?
The author recommends an expanding window, which is also known as anchored fitting. Here's how it works. You use data from 1990 to design and optimize your rule. You then lock in those parameters. You take that locked rule and test its performance on the unseen data of 1991. You record the profit or loss. Then you step forward. You expand your training data to include 1990 and 1991. You re-optimize the rule, lock it, and test it on 1992. You iterate this year by year. You only ever use the past to predict the future.
I've also heard of something called a rolling window. How is that different? And I have to admit, I'm losing you a bit here. If I use a rolling window where I drop old data, say I only ever look at the last 3 years to fit my model, aren't I just reacting to recency bias? How is dropping old data any different from the overfitting that the 50 model kid was doing?
That is a great question. A rolling window does carry the risk of recency bias because you are assuming the immediate past is more relevant than the distant past. It is useful if you believe the fundamental structure of the market has permanently shifted, like the transition from floor trading to electronic trading. But you are absolutely right to be skeptical. Whether you use expanding or rolling windows, you are still iterating. And the more you iterate, the more you run headfirst into a mathematical nightmare known as the multiple testing problem.
Let's unpack the multiple testing problem, because this is where the author really drops the hammer on anyone trying to mine data for profits.
Okay, let's do a thought experiment. Suppose you write a computer script that generates 100 completely random trading rules. These rules are based on literal white noise. They buy and sell on completely random days. By definition, the true underlying expected return of every single one of these rules is exactly 0. There is no edge. Now, you backtest all 100 of these worthless rules over a decade of data. What happens?
Well, I assume most of them show 0 return minus trading costs.
Most of them do. But because of the sheer variance of random chance, some of them will accidentally catch a few major trends. If you set a phenomenally high standard, say you demand a Sharpe ratio of 2.0 or higher, the math dictates that out of 100 purely random rules, at least 2 of them will cross that 2.0 threshold simply due to dumb luck.
So just by rolling the dice enough times, garbage actually looks like gold.
Exactly. This is why testing thousands of parameters, like that 50 model kid did, guarantees that you will select rules that look brilliant in the backtest but have absolutely zero predictive power in the real world. You aren't finding alpha, you are just finding the luckiest lottery tickets of the past decade.
So how do we ever prove a rule isn't just a lucky lottery ticket? Like, how much data do we actually need to be statistically confident?
The author lays out the brutal math of statistical significance using a standard t-test. Earlier, we agreed that a highly realistic, solid Sharpe ratio for a single rule on a single instrument is about 0.3. If you want to mathematically prove with a 95% confidence level that your 0.3 Sharpe rule is genuinely profitable and not just random noise, do you know how many years of daily data you need?
I don't know, maybe a full market cycle, 5 to 10 years.
You need roughly 40 years of daily data.
40 years.
Yes, 40 years just to prove a single rule has a positive edge. And if you want to prove that rule A is statistically superior to an uncorrelated rule B, say, you're trying to decide whether a 20-day moving average is definitively better than a 50-day moving average, you need about 30 years of data to make that call with any real statistical confidence.
But hold on, that completely breaks the model. We don't have 40 years of daily data for most modern financial instruments. The VIX index didn't even exist in 1980. Cryptocurrencies didn't exist 20 years ago. Many commodity futures contracts only gained real liquidity in the last 2 decades. If we need 40 years of data to prove anything, and we only have 15 years of data, are we all just flying completely blind? Are quantitative hedge funds just guessing?
If you approach the problem by testing highly specific, custom-fitted rules on single instruments, like if you try to build one unique rule just for crude oil and a completely different unique rule just for wheat, yes, you are completely guessing. You will never have enough data to prove they work. But there's a brilliant, elegant workaround, and it forms the absolute cornerstone of the author's systematic framework. It is called pooling data.
Explain pooling to me. How does it bend the math?
Instead of designing a custom rule for every single asset, you intentionally design a highly generic, universal rule like a simple price momentum tracker, and you apply it simultaneously to a massive, diversified portfolio of instruments. You run the exact same math on oil, wheat, bonds, and equities.
But how does that solve the 40-year problem? You still only have 15 years of oil data.
Because of the diversification bonus, if you take a generic rule that has a weak, noisy Sharpe ratio of 0.13 on a single instrument, you'd need centuries of data to prove it works. But if you apply that exact same rule across a highly diversified portfolio of 50 uncorrelated assets, the magic of diversification smooths out the variance. The overall system's Sharpe ratio jumps from 0.13 to, say, 1.13.
Because the losers cancel out, but the underlying positive edge compounds across all 50 assets.
Precisely. And because the system's Sharpe ratio is now much higher, and the variance of the daily returns is much lower, the required math changes drastically. You only need about 11 years of portfolio history to statistically prove that a 1.13 Sharpe strategy is valid compared to the 40 years you needed for the single asset. By standardizing the rules and pooling the data across multiple markets, you artificially manufacture the statistical significance you so desperately need.
That is just an incredibly elegant solution to what seems like an impossible mathematical problem.
Yeah.
Okay, so let's take a breath and recap where we are, because we are about to put the engine into the car. We have mapped the psychology. We know we are emotional time bombs. We know the theoretical sources of profit like risk premia and forced traders. And we know how to bypass the statistical traps of backtesting by using out-of-sample data and pooled diversification. Now we have to build the actual physical machine. We have to bolt all these conceptual pieces into a daily operational framework that won't blow up our bank accounts.
And to truly appreciate the genius of the author's framework, we first need to dissect how most amateurs build their systems and why those systems inevitably fail. We need to look at what I call the bad internet system.
Right. If you go on YouTube right now and search for a trading system, you will find thousands of videos offering a rule set that sounds something like this. Step 1. Buy the stock when the 20-day moving average crosses above the 40-day moving average. Step 2, bet exactly 3% of your total account capital on the trade. Step 3, set a 3% trailing stop loss to protect your downside. Now, to a novice, This sounds incredibly prudent. It has a clear entry rule, it manages position size, and it has a hard stop loss for protection. What is fundamentally wrong with it?
It sounds prudent, but underneath the hood, it is a tangled, contradictory, dangerous mess. Let's start with that 3% stop loss. Where does the number 3% actually come from?
It usually comes from a trading book saying never risk more than 3%. It's based on human pain tolerance.
Exactly. It is based entirely on human pain, not on the mathematical reality of the market you are trading. A 3% static stop loss applied to a highly volatile, erratic market like crude oil might get triggered by completely random daily noise within 10 minutes of you opening the trade. You will be stopped out constantly.
Yeah.
Conversely, if you apply that exact same 3% stop loss to a quiet, slow-moving market like short-term interest rates, it might take 3 years of a massive, grinding bear market before the stop is finally hit. The stop loss is entirely disconnected from the asset's actual underlying volatility.
And the position sizing rule, betting 3% of your capital on every trade, is totally absurd when you try to scale it out. Like, if I am following this guru's rules and my stock screener suddenly finds 40 different tech stocks that all meet the moving average crossover criteria on the exact same day, I take all 40 trades, risking 3% on each, and I suddenly have 120% of my total portfolio at risk, I am massively leveraged without even realizing it.
Because the system is rigidly welded together. It's not modular. The entry rule dictates the risk, and the risk dictates the stop loss, and they are all glued into one unchangeable lump.
The author uses a fantastic analogy here.
Eh.
Imagine walking into a car dealership to buy a car. You ask the salesman, hey, I like this model, but can I get alloy wheels instead of steel? Or maybe a slightly bigger engine. The salesman looks at you and says, no, it only comes exactly as it is. You ask, okay, how fast does it go? He says it goes exactly 150.6 miles per hour, always, no matter who is driving or what road you're on. Public trading systems are like cars welded together out of a single block of metal. You can't ask, why a 20-day average? Or what if I only want to risk 1% instead of 3% because the components are modular? You cannot separate the engine from the chassis.
To fix this catastrophic design flaw, the author's framework demands that we cleanly separate every single component. And to do that, it establishes one absolute ironclad rule that governs the entire architecture. The trading rules and the stop losses must depend only on the statistical market volatility of the asset. They must never, ever be influenced by your account size, your personal pain threshold, or your financial goals.
Okay, wait. If my account size and my personal tolerance for pain don't dictate the stop loss, where do they live in this framework? I have to have some control over my own money.
Your personal preferences live entirely within a single, isolated, top-level module called the Volatility target. Think of this as the master dial on your dashboard. This dial dictates exactly how much total cash you are willing to risk losing on an average day across your entire portfolio. You, the human, set the volatility target based on your total wealth, your psychological risk tolerance, and your access to margin. That is your only input.
Okay, so the rules don't know my bank balance.
Exactly. The individual trading rules down in the engine room don't know how big your account is. They just monitor the market and spit out mathematical forecasts. The position sizing module then acts as the transmission. It takes those raw forecasts, looks at the current market volatility, looks at your master volatility target, and calculates exactly how many shares or futures contracts you should buy to hit your target.
And the beauty of this modularity is that it adapts to completely different types of investors. The framework isn't just for day traders. The author introduces 3 very different archetypes in the book. I want to address you, the listener, directly for a second. Think about your own philosophy and see which of these 3 avatars sounds most like you. First, we have the asset allocating investor. This person is highly skeptical of anyone's ability to time the market or forecast price movements. They don't use leverage, they prefer cheap and diversified ETFs, and they run a static long-term portfolio. They just want a smarter way to balance their risk.
Which is a very sensible, widespread approach.
Second, we have the semi-automatic trader. This person believes they actually do have some discretionary skill. They watch the macroeconomy, they make opportunistic bets based on their own gut feeling or fundamental analysis, and they are perfectly comfortable using leverage like spread bets. But they recognize their emotional flaws, so they want a rigid mathematical framework to manage their position sizing and enforce their stops while they make the actual directional calls.
They want to be the driver, but they want the system to operate the anti-lock brakes and the airbags.
Exactly. And third, we have the staunch systems trader. This is the fully automated hardcore quant. They use purely mathematical rules. They trade across dozens of global futures markets, and they're very comfortable writing code and running deep statistical backtests. The absolute brilliance of this book is that all three of these people use the exact same position sizing, risk management, and portfolio allocation chassis that simply swap out the engine that generates the forecasts.
That is the power of true modularity. But regardless of which archetype you are, the raw fuel that powers the engine is the instruments you choose to trade. This is the very first module, and the framework requires strict, unforgiving instrument filtering.
Walk us through the filters. What gets thrown out?
First, you must have clean, reliable, historical daily price data. If you can't get accurate data, you cannot systematically backtest it, which means you cannot trade it. Second, the minimum allowable trade size must actually fit within your account's volatility target.
Give me an example of something that wouldn't fit.
Consider a Japanese government bond futures contract. It is a fantastic, highly liquid instrument for institutions. But a single contract has a notional value of over $1 million US. If you are trading a $50,000 personal account, even one contract is far too massive for your risk tolerance. The system's math will tell you to buy 0.02 contracts, which is physically impossible. So the Japanese government bond gets filtered out.
Okay, so it has to fit the account size. What else?
Third, you must fundamentally understand why the market moves. You need a structural thesis. And fourth, you must ruthlessly avoid any instrument with artificially low manipulated volatility.
Right, this goes straight back to the Swiss franc example we talked about earlier.
Precisely. Pegged currencies or heavily manipulated markets have artificially compressed standard deviations because the framework automatically increases position sizes when volatility drops to maintain your master volatility target. If you feed it a pegged currency, the system will look at the flatlining price, assume the asset is virtually risk-free, and instruct you to take a massive, highly leveraged position. When the central bank eventually breaks the peg and the volatility explodes, your account is utterly destroyed. So you filter those out entirely. What you want remaining after the filtering process is the largest, most diversified, lowest correlation portfolio of instruments you can possibly afford to trade.
Okay, so we have our filtered universe of instruments. The next critical module is the forecasts. This is the interface, the translator, between the trading rule that spots the opportunity and the position sizer that allocates the cash. So what does this all mean? The author is adamant that a forecast can never be a simple binary buy or sell signal. It has to be a granular scaled number.
Yes, a forecast is a number where the sign dictates the direction positive for a long position, negative for a short position, and the absolute size of the number represents your level of mathematical conviction in the trade. But to make this modular interface work across a globally diversified portfolio, the forecast must have a universally consistent meaning regardless of the asset. A strong buy signal on a barrel of crude oil must mean the exact same thing mathematically as a strong buy signal on a sleepy 2-year government bond.
Wait, back up. How exactly does the system equalize crude oil and a 2-year bond? Crude oil can move 5% in an hour on a geopolitical headline. A 2-year bond barely moves a fraction of a percent in a month. I need to see the math of how you make them equal.
You achieve it through a process called volatility standardization. You scale every raw forecast so that it is directly proportional to the expected risk-adjusted return, essentially the expected Sharpe ratio. Here's the math. The system continuously measures the recent historical standard deviation of the asset's daily price changes. Let's say it determines that crude oil is currently 10 times more volatile than the 2-year bond. When a trading rule generates a strong buy for both assets, the volatility standardization module automatically divides the crude oil position size by 10 relative to the bond.
Ah, I see. It's like a universal volume knob.
Yes.
If I want to listen to a heavy metal concert crude oil and a whisper, the 2-year bond, at the exact same volume, the framework automatically dials down the gain on the jet engine and cranks up the gain on the whisper, so they both output the exact same decibel level of risk into my portfolio.
That is a phenomenal analogy, yes. The framework calibrates the rules so that an average everyday forecast always has an absolute value of 10. A plus 10 is an average everyday buy signal. A minus 10 is an average everyday sell signal. And crucially, these forecasts are strictly hard-capped at plus or minus 20. The system will never output a plus 25.
Why cap it, though? Like, if my discretionary analysis is flawless or my quantitative rule spots an absolute once-in-a-decade sure thing, why shouldn't I bet the farm and output a plus 50 forecast?
2 reasons: risk control and statistical humility. First, mathematically, extreme forecasts occur very, very rarely in the historical data. Because they are rare, we have very little statistical evidence proving that they actually work better than a normal forecast. You are stepping out of sample. Second, extreme market conditions that generate extreme forecasts usually snap back. Markets are prone to violent mean reversion, the classic dead cat bounce. Capping the forecast at 20 prevents any single wildly confident rule or any single moment of human hubris from hijacking the risk of the entire portfolio and blowing you up.
So how do our three archetypes, the allocator, the semi-auto, and the quant, actually generate these 10s and 20s to feed the machine?
It is remarkably elegant. The asset allocator, who doesn't believe in timing the market, simply hard codes a constant plus 10 forecast for every single asset in their portfolio every single day. Because the framework automatically volatility standardizes everything, applying a constant plus 10 forecast creates a perfectly self-adjusting risk parity portfolio. As stocks get more volatile, the system automatically shrinks the stock position and buys more bonds without the investor doing a single thing.
Oh, wow.
The semi-automatic trader uses a simple lookup table provided in the book to convert their subjective human gut feeling into a number between -20 and +20, inputs it, and lets the system calculate the exact dollar amount to risk.
And the staunch systems trader.
They feed the engine with systematic mathematical rules. The author provides two primary workhorse rules that account for roughly 85% of his own proprietary system's performance. The first is EWMAC, the exponentially weighted moving average crossover. It constantly tracks a fast-moving average of the price and a slow-moving average. When the fast average crosses above the slow average, it mathematically spits out a positive forecast. This is a pure, classic trend-following rule. It cuts losses quickly and rides winners, which gives you that safe, positive skew we want.
And to balance out that trend-following rule,
The second workhorse rule is carry. Carry is the fundamental return you generate if the asset's price remains perfectly, totally flat. For a stock, it's collecting the dividend yield minus the interest rate you pay to borrow the cash to hold the stock. In currencies, it is the interest rate differential between the two countries. Carry is designed to exploit the forced traders and leverage aversion we discussed earlier. Now, carry naturally has negative skew. It grinds out steady profits until it abruptly doesn't. But because it relies on fundamentals rather than price momentum, it is highly uncorrelated to the trend rule. It diversifies the portfolio beautifully.
okay, here is where we hit a massive logistical problem. If I am a quant and I have a trend rule and a carry rule running on the exact same asset at the exact same time, they're going to disagree.
Oh, constantly.
The EWMAC trend rule might look at crashing oil prices and scream, it's a -15 strong sell. But the carry rule might look at the futures curve, see an incredibly cheap yield, and say it's a +5 week buy. I cannot physically put on two conflicting trades in the same account. I need one single combined forecast to hand to the position sizer.
To resolve the conflict, you take a weighted average of the individual forecasts. You assign specific forecast weights to each rule based on how much you trust it.
But where do those weights come from? I can't just guess. This seems like another place where the math could go horribly wrong if I just let a computer decide.
And it frequently does go horribly wrong for amateur quants. If you feed the historical returns of your rules into a classic Markowitz single-period optimizer, which is the standard algorithm taught in business schools, the algorithm makes a fatal assumption. It treats historical data as perfect, immutable, absolute truth.
But we know historical data is incredibly noisy.
Exactly. The optimizer is completely blind to uncertainty. Let's say your trend rule generated a Sharpe of 0.45 over the last decade, and your carry rule generated a 0.42. To an optimizer, 0.45 is definitively infinitely better than 0.42. So the optimizer will spit out wildly unstable extreme portfolios. It might instruct you to put 100% of your portfolio weight entirely on the trend rule and 0% on the carry rule just because trend got slightly lucky and had a tiny bit less noise in the backtest.
It's that overfitting trap all over again. We are optimizing for the noise, not the signal.
Yes. With only 15 or 20 years of data, we know it is mathematically impossible to confidently distinguish the true underlying Sharpe ratio of two similar rules. However, we can reliably measure their correlation. We can easily calculate if two rules tend to buy and sell at the same time, or if they act independently.
So instead of using a flawed, extreme computer optimizer that pretends to know the exact returns, the author suggests a simpler pencil and envelope method called handcrafting. Walk us through handcrafting because it feels like the secret weapon of this entire framework.
Handcrafting is a bottom-up, fiercely modular approach to portfolio construction. Instead of throwing all your rules and assets into a black box optimizer, you manually group highly correlated assets or rules into distinct clusters. For example, if you are running 3 slight variations of a fast-moving trend rule, you group them together. Then you use a remarkably simple, pre-calculated table 8 in the book, which assigns fixed percentage weights based purely on the correlations within that specific group.
The logic being that unique diversifiers are rewarded with higher weight, and highly correlated clusters are punished so they don't dominate the portfolio.
Exactly. If you have one unique carry rule and 3 highly correlated trend rules, Table 8 ensures the carry rule gets a massive chunk of the allocation because it brings unique diversification. The 3 trend rules, meanwhile, are forced to slice up the remaining allocation among themselves. It physically prevents redundant rules from doubling or tripling your risk exposure. Once you have calculated the weights within the subgroups, you do the exact same process across the main groups, multiplying the percentages down the tree to get your final, safe, deeply diversified, and decidedly unextreme forecast weights.
Okay, I have my handcrafted weights. I multiply my individual conflicting forecasts by these weights, and I add them all up to get my final combined forecast. But wait, let me do the math here. If I take a weighted average of a plus 15 forecast and a conflicting minus 5 forecast, the math brings the combined result closer to 0. It might be plus 5. If I have a highly diversified set of 10 rules, some long and some short, won't my combined forecast naturally just squash itself down to 0 through the sheer gravity of averaging? It won't average an absolute value of 10 anymore, which means I won't hit my volatility target. I'll be chronically underinvested.
You have spotted the final mechanical hurdle. Yes, diversification fundamentally shrinks the variance of the forecasts. So, to fix this, the framework introduces the final module, the forecast diversification multiplier.
Walk me through the math of this multiplier.
The framework calculates a mathematical ratio of how much the diversification process has historically squashed the combined forecasts for that specific asset. If it finds that combining your rules typically shrinks the average absolute forecast down from 10 to, say, 5, the diversification multiplier is 2, you then multiply your squash combined forecast by 2 to inflate it back up to its proper expected absolute value of 10.
I am turning the master volume knob back up to compensate for the rules canceling each other out.
Precisely. You restore the intended risk level. And because that multiplier can occasionally take an already strong combined forecast and push it into highly dangerous extreme territory, you apply the hard cap of plus or minus 20 one final time. The output of this entire gauntlet is a single, perfectly scaled, volatility standardized, strictly capped forecast. That number is finally handed to the position sizer, which calculates the exact number of shares to buy.
That is it is an incredible piece of financial engineering. It takes a chaotic, emotional process and turns it into a factory assembly line. Which brings us to the end of our journey today. Let's pull this massive arc together for you, the listener. We started this deep dive looking at a human brain, your brain, that is quite literally wired by millions of years of evolution to lose money in modern financial markets. We suffer from Get-Evenitis, we frantically cut our profits early due to regret aversion, we fall for the narrative fallacy, and we blow up our accounts through overbetting because we are wildly overconfident and blind to the math of standard deviation.
And we learned that the only defense against that evolutionary baggage is a rigid commitment mechanism. We need an objective, strictly rule-based system that establishes a line in the sand and physically prevents us from meddling when we get scared.
We then bypassed the statistical traps of the industry. We threw away the in-sample time machine. We stopped optimizing our models for historical noise, and we learned to pool our data across massively diversified instruments to find simple rules that actually have mathematical significance rather than just waiting 40 years to prove a single theory.
And finally, we built the fully modular machine. We divorced the trading rules from our personal account size. We ruthlessly filtered our instruments. We used volatility standardization to make sure every forecast from oil to bonds spoke the exact same mathematical language. We handcrafted our portfolio weights to prioritize safety and diversification over back-tested illusions, and we created a unified system that dynamically scales to market risk, protecting our capital when the sirens start singing.
It is a phenomenal, robust framework. But as we wrap up, there is one final, highly provocative thought stemming from the source material that I want you to mull over. We've established today that systematic rules, like the EWMA trend-following rule, are largely designed to harvest the cognitive biases of discretionary human traders. The systematic machines generate their alpha by feeding on the people who are panicking during crashes, and the people stubbornly holding losers while selling winners.
Yes, the systematic framework fundamentally extracts its profit from the emotional weakness and prospect theory of the human beings on the other side of the trade.
But the global investment landscape is shifting beneath our feet. Passive index investing is growing at a massive, unprecedented scale. And more importantly, more and more of the world's active institutional capital is being handed over to algorithmic, automated, systematic frameworks exactly like the one we just built. The pool of emotional, discretionary, error-prone humans available to be exploited in the market is steadily and rapidly shrinking.
Which raises an incredibly important, almost existential question for the future of finance. If the computers and the objective, emotionless frameworks eventually drive out all the discretionary human traders, who will the systems feed on? Do the behavioral risk premia eventually evaporate entirely? Do these deeply researched rules just stop working? Or do the systematic machines simply start hunting each other, creating entirely new, bizarre, algorithmic market structures that we can't even comprehend yet?
It is a chilling thought. If the human flaw is the ultimate source of the profit, what happens when the human is removed from the market entirely? We will leave you with that to chew on. Take these concepts, pull up your own brokerage account, look closely at your own portfolio, and ask yourself honestly, are you driving a fully modular, carefully engineered machine with the rules securely tied to the mast? Or are you just wandering through the grocery store while hungry, letting your primal emotions steer your financial ship directly toward the rocks? Thank you so much for joining us on this deep dive into the mechanics of systematic trading. Until next time.